Are books on your to-read list still waiting for you? Do you need some inspiration? Then tune in to HT Smartcast and dive into the literary world with books and authors. Join National Books editor Manjula Narayan as she explores the journeys of your favorite books and the brilliant minds who penned them. From uncovering the history behind our favorite dishes to navigating the vastly varied cultural landscapes in India, each episode is a deep dive into fascinating stories and delectable conversations. Don't miss out on episodes like of Khichdi, Kheer and Khayali Pulao. This podcast is available on all audio streaming platforms.
You're listening to a Mint podcast brought to you by HT Smartcast.
Hey everyone, welcome to another episode of Why Not Mint Money. Today we are again here with Mr. Vaibhav Sanghavi as our guest for the day. We previously did a podcast with Vaibhav on Arbitrage Funds post 2024 and how investors can look at long-short funds as one of the alternative to arbitrage funds. If you haven't checked that episode, please do check before listening to this one. Vaibhav is the CEO of ASK Hedge Solutions with moreover than 20 years of work experience and a significant contribution to Cat 3 AIF space. He will today help us understand the concept and all you need to know about long-short funds.
Welcome to Why Not Mint Money, a personal finance podcast where we help you understand basic money concepts and share strategies for you to build your wealth. So let's get started with your money journey.
Hi Vaibhav. So help us understand the concept of the long-short funds in simple terms to our listeners.
So I think Anil, nowadays, as I said, that the long short as a terminology, is used very loosely. But as a basic concept to understand what long short funds are about, it only gives you an ability to buy stocks which you like for any of the underlying reasons, which we term as, and sell stocks or short stocks for any underlying reason which you don't like. Now, effectively, you would say that, why would I be going long stocks and short stocks? There are a lot many nuances, there are a lot many factors in terms of risk management and an ability to kind of generate consistent returns over a period of time, which makes the long short funds as with a distinct advantage as compared to your traditional investment instruments.
Right. So, Vaibhav, I had this question for you that what type of investors is this AIF, long short AIFs are suitable and who should invest in this fund?
Before kind of, understanding the profile of the investor, then in which you can, judge that, SEBI mandates that the minimum corpus one can invest into an AIF, especially in category 2 and category 3, is a minimum of 1 crore rupees. So any investor who has commensurate net worth, wherein the small portion of their investment they would want to probably invest, ideally has to be a HNI, ultra HNI, or family offices or some corporates. So those are the segments of investors who ideally look at alternate investment funds, who are looking for a value add and who are looking for a risk-adjusted return, strategy or an addition to their own existing portfolios.
Right. Okay. Like you just mentioned, the concept of, the long short funds, like if you just simply explain that if you are positive on a stock, you go long on that stock. And if you're not positive, if you don't have a positive outlook on that stock, you go short on the stock. In this case, what are some risks involved in these type of strategies? If you can help us understand that to our listeners.
Of course, I think it's a very important question here. And what I would say is that a long short fund or a long short methodology can be used to manufacture strategies which are extremely conservative in nature to extremely aggressive in nature as well. Now, you would assume or you would ask a question that, how is it that possible? Because long short fund is just one terminology. Now, all depends on what the underlying net open positions you would want to kind of probably run. Now, what do I mean by open here is that your long minus shorts, right? is what determines on an broad base that if you have a lower net exposure on prima facie be a conservative strategy, or if somebody has a higher net exposure and ability to take a higher net exposure would primarily be an aggressive strategy. Now within these there are lot many permutations and combinations and styles of doing the long short, but risks are a factor of one, the net exposure you carry, two, the volatility and the standard deviation, which means that the returns you generate from this strategy is coming at what kind of volatility. And two other important factors are one, that what is the characteristics of the profile of a strategy with respect to the drawdowns, meaning the negative returns you earn in a down market or in a particular month or a period which you may probably want to define as, right? And lastly is basically a scenario analysis which kind of determines that, say for example, if the market goes down by say tomorrow morning 15%, 20% down, or probably 15% or 20% up, then how is it that your portfolio would behave in those kind of circumstances? So all of these factors would probably determine whether the strategy is very conservative or probably very aggressive as well. These are the nuances you would have to probably look for.
Right. And right, as you mentioned, the kind of drawdown that the fund experiences when the market experiences drawdown defines the risk involved in the fund, right? So if one were to look at both, let's say arbitrage and long short funds, when markets experience drawdown, which of the funds experience more volatility in among both of them?
Of course, when market would witness, say for example, a big drawdown, my sense is basically that the arbitrage fund would be a little more conservative and probably would have a little lower drawdown profile or probably no drawdown. Whereas in case of long short funds, depending upon the underlying strategies you may have, will also depend how much of a drawdown profile you would probably have. Now, considering that if you have an extremely conservative strategy which will not take any directional call or will not take any open exposure in that sense, then probably you would be close to those arbitrage funds. But when you are extremely close to the arbitrage funds, then the commensurate returns you may generate also would be pretty much close to your arbitrage funds as well. It is that the long short funds, when given an ability to do lot many other things, is an addition of a risk adjusted basis. You are trying to improve the return profile on an overall basis. So that is how we would look at that in a down market, while arbitrage funds would be very, very conservative and would be better in the drawdown profile. Unless it's a very conservative fund from a long short perspective, I think the volatility of the returns would be higher than the arbitrage funds.
Right. So as you mentioned, there are depends on the underlying strategy. So what are some few strategies? I know there would be a lot, but what are some few 2-3 strategies? Let's cover the first, the most conservative ones, which is very close to arbitrage fund, which you mentioned, and the rest 2-3 which you feel the listener should be aware of. And which one should, how does one decide that which one should go and invest in?
Sure. Now, depending upon your risk appetite, of course, is a very broad-based statement to kind of make and tell you that you should accordingly choose the long-short strategy. But let me kind of, give you a broad spectrum of how we classify strategy as, which is probably easy to understand from an investor's perspective. There is a very conservative bucket of your strategy, which is resembles like a debt or a debt equivalent kind of strategy in terms of standard deviation or volatility, in terms of the drawdown profile, and possibly an ability to give you returns which are marginally higher than your debt returns. So there you are adding value from a risk adjusted return basis, that where at the same time while you are adding returns on your debt portion, you are trying to manage the risks like a debt instrument, right? In terms of the standard deviation, volatility, and the drawdown. So again, an example of how long short can be used as a risk adjusted basis. That's on the conservative side. Now, if you kind of take that, few of those strategy which is higher up the risk curve, there is another bucket where what you ideally would want to do is basically place it against your equity returns. Now, when we talk about equity returns, the aim with those kind of strategies would be to see to that if you can generate returns which are better than equity as an asset class, with risks which are much better than the other equity instruments. When we talk about risk here, the essential focus may be on the drawdown profile of those strategies. So you use again the long short methodology to kind of construct a strategy or manufacture a strategy which also competes against your traditional equity, large cap, mid cap allocation as well. So you can use, as I had mentioned, that long short across the risk spectrum to try and see what suits to the portfolio or the financial goals of the investor. But it is certain that it has a ability to add huge amount of value in their respective buckets as well.
Right. So for the first conservative strategy you mentioned, which is quite close to your debt-like instruments and also arbitrage. And the second you mentioned that there are long-short strategies which might be which in terms of returns also can be aligned with your traditional equity large cap funds. How does the risk reward ratio look like if we compare both in both conservative?
Of course. So
yeah, go ahead. Yes,
sure.
please.
Sure. So when we talk about a conservative strategy, typically you will find that the volatility standard deviation on a daily returns, anywhere between 2 to 4%. Whereas if you look at an equity strategy, their standard deviation or volatility would be close to the market-like volatility, which is about 15-16%.
Much higher.
Now, while those are much higher, those are the numbers on the volatility side, important is also to look at the drawdown profile as well. While on a conservative side, long short funds would rarely give you a negative month in terms of the drawdown. What on the aggressive side kind of happens is basically it would give you a drawdown profile or has an ability to give you a drawdown profile which is much better than your underlying equity class. And I'll give you one example. There is basically that in a month like a COVID month, which is when the markets were down about say 25-26%, one of our strategies on the equity side, which is a long short strategy on the equity side, actually fell down much lesser than that 25-26% of drawdown which you saw on the markets, right? Again, it only gives you an ability to better the risk profile, give that comfort to the investor that no, I'm not kind of doing much better in a downward market. And at the end of it, also deliver a return which is better than your equity underlying asset class as well. So it's a combination of all these factors which make them, very attractive from an investor's standpoint and portfolios.
Sure. Yes. So Vaibhav, like you mentioned earlier in the podcast, that the SEBI mandate says that this product is suitable for HNIs, family offices, like usually people with the higher net worth. And I'm sure there are a good number of people in this, investors in this category who have been relying on arbitrage for a long time. What would be your piece of advice for those people before they get started with long short AIFs as an alternative to arbitrage fund?
Sure. When you are looking for an alternative to arbitrage fund, let's understand that the purpose of investing into our arbitrage fund is to not take a risk. Okay, you are looking to park your conservative money into an instrument which is slightly better from a post-tax return perspective as against your existing debt instruments.
Okay.
We have to be also very clear that the arbitrage funds doesn't mean that it's, or clearly means that it is not taking risk like an equity, nor giving you that return like an equity. So to compare well or to probably categorize well, I would clearly think that the long short funds on the conservative side is a right comparison or a better comparison to the arbitrage funds. Now, if a conservative fund from a long short perspective has an ability to generate, say, about 150 basis points higher than your arbitrage fund post tax, post fees, my sense is basically it's a phenomenal alpha, considering that your debt bucket, if you can deliver 150 basis points of alpha, it can add huge amount of compounding returns over a longer period of time. Right? So that is how you should probably look at. If you're looking at arbitrage funds, please look at the conservative strategies on the long short side.
Right. Okay, I think we have covered almost all questions. Just one question I had. So Vaibhav, you might be knowing that SEBI's new asset class proposes strategies, which are different from the traditional mutual funds. One of them, which was mentioned in the consultation paper, is they have given an example of long short fund, and the ticket size goes from 1 crore to 10 lakh rupees. Someone who can get exposure to these kind of long short funds who are not comfortable with 1 crore ticket size. What are your views on that?
Yeah, I think whatever innovation or probably newer guidelines are happening, probably or in the process of being made, there's a wider consultation which is currently on, and various stakeholders are giving their opinions and their views, to the regulator within these kind of guidelines. Now, we have to realize from an overall perspective that while the long short funds were categorized or probably initiated under an alternate investment fund umbrella, and especially on the category 3, it was meant to be that complex strategies can be constructed under an alternative investment fund category 3 umbrella.
Yeah.
However, what we have seen probably in the last 11 years is that rather than having complex strategy, the category 3 AIF umbrella is actually moving larger to your simple long only strategies, and SEBI by this proposal is actually moving those complex strategies probably into a mutual fund umbrella for the retail investors. Now, my sense is basically some amount of harmony probably is needed to see to that we achieve the goals, or are probably able to offer the right strategies to a retail investor who is not very well exposed to the terminology of the long short funds. So it is extremely important, one, to have right adequate talent and experience to manage those kind of strategies who have done for a longer period of time, and at the same time to categorize well without giving kind of from, if it's a retail kind of background, any leverage or sort of extra risky proposition from that kind of strategy perspective as well. So we'll wait for the final guidelines, but to make the whole long short ecosystem pretty robust, it's a step in the right direction. But provided the consultations kind of happen and guidelines come after due consultation process, which is good for all, my sense is it will add great value to the whole ecosystem.
Right. So Vaibhav, thank you so much for the knowledge that you have shared with us today. And I am just done with my questions. If you have any things that we have missed out, you think, in this podcast while we talk about long short funds, you can just go ahead and share your inputs.
No, I think, Anil, I think most broader questions have been kind of covered, and my view is that having the larger piece in this case in terms of the basic knowledge of long short, I think it will be extremely important.
Yes,
we can always have a further kind of session in terms of how, from a global standpoint, quant strategies, fundamental long short strategies, how do they come into picture? What are the categorization of those kind of things, at a later date in much probably depth as well.
Right. Thank you so much, Vaibhav. I'm sure this episode will be helpful for someone who is new to or wants to understand basics of long short. And thank you so much for joining. Thank you so much for having joining us today. Thank you.
Thank you very much, Anil.
Yes,
Thank
yes,
you.
Yes.
To stay updated on this podcast, follow us at HT Smartcast on all the major social media platforms. To listen to more such podcasts, log on to www.htsmartcast.com.
Are books on your to-read list still waiting for you? Do you need some inspiration? Then tune in to HT Smartcast and dive into the literary world with books and authors. Join National Books editor Manjula Narayan as she explores the journeys of your favorite books and the brilliant minds who penned them. From uncovering the history behind our favorite dishes to navigating the vastly varied cultural landscapes in India, each episode is a deep dive into fascinating stories and delectable conversations. Don't miss out on episodes like of Khichdi, Kheer and Khayali Pulao. This podcast is available on all audio streaming platforms.